Over the past year or so, have you ever felt that frustration needing hundreds or thousands of dollars to invest in companies like Amazon, Apple, or Google? Well, in today's video, I'll be sharing with you how you can start investing in companies like Tesla for $20 Canadian. And no, you don't have to convert it to US dollars and pay that bloody exchange fee. And this is possible on platforms like Wealthsimple Trade, Questrade, as well as TD Direct Investing. They're called CDRs, or Canadian Depository Receipts. Now, if you're sitting there scratching your head thinking, what's the catch behind these? Well, we'll also go through those as well. So you're going to want to pay attention and understand what CDRs are. Now, before moving on to CDRs, if you guys are currently hoarding a lot of cash and just don't know where to put it in the market, well, look no further. I use EQ Bank to put my emergency savings funds in there. Currently, at the time that I'm releasing this video, the interest rate on their account is 1.25%. Now, if you compare that with some of the biggest banks in Canada, like Royal Bank and Bank of Nova Scotia, they pay a 0.05%. EQ Bank beats that by 25 times. And if you go to TD Bank, they only pay a 0.01%. So EQ Bank is better by 125 times. If you're interested in opening up an account or want more information, I've got a link below in the description. If this is the first time you've ever heard of a CDR, then you're not alone, because just a couple weeks ago, I learned about them. And essentially, CDRs are similar to what ADRs are, which are American Depository Receipts. And basically what they allow investors to do is buy foreign companies in their own local currency. So on the US stock exchanges, you can buy companies from all over the world like China or Europe by buying an ADR. Now in Canada, this is the first time we've ever got something like ADRs, and they're called CDRs, of course. There's only a limited number of companies that are available to be purchased through the CDR program. And these CDRs are offered by CIBC, and they're listed on the NEO exchange. Now, if you're wondering, can I buy these on Wealthsimple Trade? The simple answer is yes, you can. You can also buy them on Questrade, TD Direct Investing, RBC Invest, and other brokerages out there in Canada. And what makes CDRs very appealing to retail investors is the low unit price. Each CDR corresponds to a fraction of the share that you're buying. So for example, if you wanted to buy Amazon, the start price for each CDR when they launch the product starts at $20. And this makes it very easy for you and I as retail investors to buy multiple units. We don't have to go out there, hoard $3,000 just to buy one share of Amazon. We can spend $20, $40, or even $60 to buy a few shares of Amazon. Of course, these are fractional shares. And to find out how much of an Amazon share you own, you have to look at the CDR ratio. And when you do the math, the CDR ratio is basically the fraction of a share that you own per CDR. If you're wondering what stocks are available for purchase through the CDR program, well, look no further. These are Amazon, Google, Tesla, Apple, Netflix, Meta, Microsoft, PayPal, Visa, Walt Disney, AMD, Berkshire Hathaway, Costco, IBM, JP Morgan, MasterCard, Pfizer, and Salesforce. And there's 4 different criteria that the stocks have to meet. The first criteria is that it must be incorporated in the US. The second criteria is that it's listed on the S&P 500 index. Criteria number 3 is that its market cap must be larger than $20 billion when the product is launched. Criteria number 4 is that the average trading volume for the stock that is going to be launched as a CDR must exceed $100 million for the previous 30 days before the stock is launched. And if a stock has a dividend like Apple or Costco, then it's paid out to the shareholders according to the number of fractional shares that they own. So if the number of CDRs that you own total up to half a share of Apple, then you'll be entitled to half the dividend paid out to a single share. Now this is where we're going to start talking about what's the catch. Since we're talking about dividends, there's a catch here. Now, seeing that you're investing in an American company and they pay dividends in US dollars, when you receive those dividends, they're not going to be paid to you in US dollars. So they have to go through some foreign exchange. So there's going to be fees associated with that. If you held the US stock instead in a US account, then your dividends will be paid out in US dollars and you wouldn't incur that foreign exchange fee. The second catch can kind of go both ways. It's the fact that this product is currency hedged. This means that the fluctuation between Canadian and US dollars doesn't actually affect the performance of the CDR because they hedge the currency. So take an example. If Apple stock goes up by 5%, then your CDR will also go up by 5% regardless of how the Canadian dollar and the US dollar exchange rate changes. Now, just to note, this currency hedging doesn't completely get rid of any sort of currency fluctuation. However, it brings down the currency risk significantly. And I think this is where CIBC makes their money. And this is point number 3. It's the fact that when they do some currency hedging, there's going to be a spread of around 0.6%, which is the profit that CIBC will take. So I think the more people who buy in the CDRs, then the more profitable CIBC will be from this product. Now, to find out how currency hedging actually works, you're going to have to do a lot more research, and you can even read into the CDR reports, which I did as well, but we don't really have time for that in this video. Another thing with CDRs is that CIBC can terminate them at any point that they want to. If these products become unprofitable for them, then they can say, we're not offering them anymore, and at that point, they'll either buy out your CDR and return cash to you, or they'll give you the underlying share. If they return your cash to you, that could mean that you have capital gains that you don't want to have if your stock is up, or you could be selling at an unfavorable time. Another con about CDRs is that they're less liquid than the stock that they're representing. So if you look at the volume of CDRs versus the volume of the actual underlying stock, you'll see a huge disparity. And I think right now there aren't many Canadian investors who are aware of what CDRs are. Their popularity could increase over time, but I think the underlying stock will always have more volume. The last point that I want to make about CDRs is that they do not track one-to-one exactly with the stock performance. So sometimes the CDR could be a little bit ahead of the underlying stock, and the reverse could also happen. Despite all these cons, I think for most investors, CDRs make a lot more sense than actually buying these stocks on the US exchange. I think most people watching my channel right now are just starting to get into investing, and you guys might be starting out with like $500 or $10,000 or maybe even $50,000. But even at these dollar amounts, I think CDRs make sense. If you're trying to exchange money from Canadian dollars to American dollars, it's fairly costly, and for all platforms, there's going to be some sort of fee to change that currency over. CDRs just make investing in US companies a lot less complicated, and you can do it with your Canadian dollars. I hope this video was very useful to you guys to understand CDRs and what they are, and hopefully you can take advantage of this new program. I've also thrown up a couple other videos on the screen here. If you're there, I'll see you there. If not, keep up the grind and have a great day.